This is Economic Foundations, Episode 1, Foundations. We begin not with markets, but with language. Understanding finance does not start with prediction, it starts with definitions. Today, we define the terms that shape economic thinking. CPI, Consumer Price Index. The Consumer Price Index measures the average change in prices paid by consumers for a basket of goods and services. It tracks items such as food, housing, transportation, and energy. If CPI rises, the cost of living is increasing. Why it matters? CPI influences monetary policy. It shapes inflation expectations. It affects wages and financial contracts. CPI is not inflation itself. It is one method of measuring it. Data sufficiency. Data sufficiency refers to whether available information is complete and reliable enough to support meaningful analysis. Incomplete data leads to fragile conclusions. Investors rely on accurate reporting, transparent disclosures, consistent accounting standards. Strong decisions require sufficient evidence. Debt-to-equity ratio. The debt-to-equity ratio compares a company's total debt to its shareholders' equity. It measures leverage. A higher ratio indicates greater reliance on borrowed capital. Leverage can amplify growth. It can also amplify risk. Balance determines resilience. Dividend coverage ratio. The dividend coverage ratio measures how easily a company can pay dividends from its earnings. It compares net income to dividends distributed. Low coverage signals potential instability. Dividends represent commitment. Coverage represents sustainability. Earnings quality. Earnings quality evaluates how accurately reported profits reflect real operating performance. High-quality earnings come from core business activity. Low-quality earnings rely on temporary gains or accounting adjustments. Profitability matters. Reliability matters more. Free cash flow. Free cash flow represents the cash remaining after operating expenses and capital expenditures. It indicates financial flexibility. Free cash flow can be used for debt repayment, dividends, reinvestment, share buybacks. Cash determines endurance. GDP, gross domestic product. GDP measures the total value of goods and services produced within a country during a specific period. It reflects economic activity. Growth signals expansion. Contraction signals slowdown. GDP measures output, not distribution, not prosperity. Inflation. Inflation measures the rate at which the general level of prices rises over time. As inflation increases, purchasing power decreases. Inflation affects interest rates, bond prices, corporate margins, consumer behavior. Inflation is velocity, not level. PCE, personal consumption expenditures. PCE measures changes in prices of goods and services consumed by households. It is the Federal Reserve's preferred inflation indicator. Unlike CPI, PCE accounts for substitution effects. PCE provides a broader measure of consumer spending inflation. Recession. A recession is a sustained decline in economic activity lasting several months. It commonly includes falling GDP, rising unemployment, declining production. Markets anticipate recession before it becomes official. Recession is contraction, not systemic collapse. Supply and demand. Supply represents the quantity producers are willing to offer. Demand represents the quantity consumers are willing to purchase. Price is determined at equilibrium. Demand rises with limited supply. Prices increase. Supply rises beyond demand, prices decrease. Markets coordinate through this mechanism. Unemployment rate. The unemployment rate measures the percentage of the labor force actively seeking work but unable to find employment. It signals economic conditions. Low unemployment suggests expansion. High unemployment suggests weakness. Extremely low unemployment may trigger inflationary pressure. Employment reflects participation in economic activity. 12 terms, 12 structural concepts. Before analysis comes language. Before prediction comes definition. This has been Lector -01. Next episode, money and central banking.